This is BullionMax, the podcast. I'm Mark Alyn, along with Sean Reynolds, the customer service manager for BullionMax. We are really pleased to bring back to BullionMax Emmanuel Daniel. He's a global thought leader in the future of finance. He knows everything about money, is what we're saying. He's got a book out. It's called The Great Transition, The Personalization of Finance is here, and we have him on our line from China, Beijing. Emmanuel, welcome back to BullionMax.
Hey, Mark, great to see you and Sean again. We've got so much to talk about today.
You know, the stock market is up and down. Earlier in the week, it was down. They didn't know what to do. Now it's up. As at least of 2 hours ago, I checked it. It was up 1%. Is the stock market going to stay where it is? I mean, the economy seems to be robust here in the U.S. while prices are climbing. Inflation has been high. Again, according to reports in the last couple of days, it's decreasing. Where are we going to go? What's going to happen in your thought?
You know, Mark, from the last time I spoke to you, I think I must have done 12 countries, going to visit them for very, very different reasons. In some countries, I had chats with the central bank governors. Some countries, I talked to technology people and so on. And then the US, and the thing that hits me about the US is the cab fare from JFK to town, and how that's changed. I still remember in the old days when it was $30 and then you went up 60. Today you can't get into town, for anything less than $90, dollars, and that's not considering traffic. So I think that what you just described is the result of excess liquidity working itself out, and I think that confuses a lot of people as to exactly what's happening. On the one hand, inflation is real. Inflation is rampant. It's not just in the US, it's in a variety of different countries. And then on top of which, you have oil prices going up. In fact, I went to at least 3 countries where there was an oil shortage. People who couldn't meet me in the hotels because there wasn't enough oil to, get the vehicles around. Stations were closed. And then there's the food crisis. I'm very sad that there are a couple of countries that I went to. Food prices have just skyrocketed everywhere. Now, the same things are happening in the US, except that people don't feel it because there is a lot of money in the economy. People don't understand that they're actually starting to pay more for the same things that they used to. And the inflation rates are not what the Fed says it is. The Fed has a basket of prices that they consider for inflation, but when you put in the discretionary spending, the real inflation is way out there. So we are in a surrealistic world at the moment, both in the US and around the world. And I think that the Fed raising interest rates has an incredibly painful effect, not just to mortgage, owners in the U.S. or people with mortgages to, pay out, but also many countries where they've borrowed in the dollar in the good times when rates are really low, and now the rates are hitting them. And when there's a knock-on effect, where countries that buy US goods can't buy it anymore because they can't afford it, there's a knock-on effect that comes back into the US. So we are, the best way to describe what you've just explained, the stock market going up and down, gold prices, sort of holding out on the higher end. But, what we're seeing is suspension in reality, meaning that it's holding out in a certain frame, but we don't know how it's going to hold out to the rest of the year. Now,
would you say, I'm sorry to interrupt, but you said a couple of things in there that I want some clarification. First of all, the economy is global. It is not China, it's not England, it's not the US, it's all of us together. Am I correct?
That is correct, and therefore, when you craft a story about what the economy is like, you cannot just tell a U.S. story, and you cannot just tell a China go to hell story either. So all the different major economies are trying to sort out a number of internal and external problems. But the one global problem that is holding the whole world together and trying to figure out a way out is the rise in US dollar rates. And the response has been dramatic, to say the least. Several countries, including Switzerland, China, Vietnam, and a number of European countries have started to sell treasury bonds, which they have held on their balance sheet for a while. Now, that is usually a case. That's usually because they are repivoting, it's calibrating, their asset base. But it also gives an excuse for countries to start looking for an excuse not to be invested in the U.S. In my book, I made an assumption that the U.S. always pays its debt, and that the U.S. always makes its commitment, and that alone enables the U.S. To borrow way beyond any other economy in the world, because all of the rest of the world is invested in U.S. debt. But a number of factors have come together, including what's happening in Congress right now, which is to raise the debt ceiling. Everyone is holding their breath, and we've done this many, many times in the last, since 1971 at the end of the gold standard. But this time, once again, it's a hair's breadth. It's a story in suspension. Everyone is just holding their breath to see how Congress works out its debt.
It's my opinion that people really don't care about anybody's world economy except their own. Okay, they want to know that they're going to be able to pay their mortgage, their car payment, send their kids to school. Will they be able to continue to do that? And could holding precious metals be a way of beating back inflation and all the high interest rates?
Holding assets that can absorb inflation, absolutely. So I think that that is the one thing that ordinary people can do. The only problem is that all of the alternative assets that you can throw out like a deck of cards, they're all overpriced at the moment. And I hate to say this, so is gold. The time to buy gold was in 2014 to 2018, when it was really, nobody was looking at it. Interest rates were really low, and everyone thought that it was the end of gold. That's the time to be invested in it. I mean, today, central banks are buying gold because of the uncertainty. And yes, there is a case for accumulating gold just in case there is a further downside risk. But I think that in terms of an investment strategy, the best time to buy when it's down.
But it, as you said, precious metals investing absorbs inflation. So right, and because we don't know where it's going to go, that this might be a good time for people to start holding, precious metals.
Absolutely. So I can't argue against that. And central banks themselves are doing exactly that at the moment. At least three that I know. So it is important to be accumulating at any time. I think that the rules that apply to securities applies to gold and any any precious metal, which is buy low, sell high. Yeah. Now, in terms of hedging inflation and hedging for inflation, the inflation that we're seeing right now is serious. I think that we need to, and it's global. So it's not just a U.S. story. I think that the newspapers in the U.S. makes it look like an American problem, but it isn't. It's a global problem right now, and therefore, we need to scramble to assets that can hold us now. So on a relative term, securities or gold, I'd say gold, because securities are incredibly overvalued. The S&P 500 is on the high side of its historical PE valuation, so it can lose a little bit more value. That is, it's overvalued. And then all of the other asset classes are not as promising as precious metals. So on that argument alone, I'd say anyone who is arguing in favor of precious metals is arguing correctly, and I won't push back on that.
Let's get an argument from my co-host and partner here, and Sean Reynolds. Sean, when people are calling into BullionMax, are they concerned about global economy? Are they concerned about what's happening here in the U.S.? Or are they more concerned about, as I said just a few minutes ago, themselves, their own families?
Yeah, they're really not thinking globally. A lot of them are thinking about what's going on with the U.S. economy, particularly what Joe Biden is or isn't doing, and how that's contributing to some pretty scary situations right now and a scary future. But the thing about it is, if inflation is the concern people have, you got to buy and hold. It's not a situation where you can just buy something and in 6 months you're going to be okay. Precious metals don't work that way. The idea is you play in the long game. You need to be able to handle the ups and downs of the market as they occur. But over time, the market gain beats inflation, the rate of inflation, time and time again. So what Emmanuel was talking about before was when you cats were napping in the mid-20-teens, when nobody was talking about gold, that's the rear view mirror. That's the ideal situation. I'll actually take out a loan to buy precious metals because I know there's going to be a return on the other side of that's going to help me out. Okay, we missed that, but now we're
unless you have a time machine.
Yes, we'll get Doc Brown and Marty McFly, and we'll go back to the future.
It's all. So anyone has not been listening, 5 years ago, well, they can replay some of your videos and
exactly. There's where the future is. It's back there in the early episodes. But I think what people want is feeling more secure and having more control over their own finances. So it really is turning those spare dollars, not getting rid of other investments and turning them into precious metals, but the spare dollars that you have that are otherwise doing nothing. They should do something. Get them in the commodities market of metal, gold or silver. They seem to be the better plays. But again, there's no short game here that's going to help you hedge against inflation.
It's not as we've said, Sean. It's not. You can't flip. Like you can't. You can't.
No. Now, I did have somebody who purchased low in September and sold recently, and he made a little bit of money, but not enough to really, think this is a big game. Oh my goodness, this is life-changing money. No, that was just being silly. He really should have just continued to hold that because he bought it at a great price. But he found his lever. He found his reason to sell.
So actually, saying is this, which is anyone's portfolio, any single person's portfolio should look like a central bank's portfolio, which is they're diversified and they have got anchor assets. The anchor assets is gold. I won't, it's a given. And if you haven't been building that portfolio and you're thinking about it only now, the operating rule is what you call accumulate. So you don't go all in, but you accumulate selectively as the markets go, and you accumulate relative to each other. So you leverage one asset class against another. So when securities are high, you let it go. Don't chase after it. And when gold looks like it's on its way down, that's when you accumulate. So the rule for building a portfolio in bad times is accumulate. That's an operating principle in investing, and that's something that I recommend. That should be the thinking or the strategy behind building a portfolio at this point.
Yeah, I think getting people to understand that you're not swinging for the fences with precious metals. The idea is that's your bedrock. That is the product that, it's never going to become worthless, but it's also not going to be the one that hits the home runs and the grand slams and all of that stuff with, oh my goodness, look at my return on my investment. It really is more of a security type of situation and hedging against inflation and making sure you don't lose everything in your portfolio in the worst of times. It's not sexy compared to some stocks and other situations where you go, oh my goodness, look at my return in such a short amount of time. That won't happen with metals. So just to set expectations appropriately. But you know what? The stuff that you buy and you accumulate and you hold, those are the types of things that you can leave to your family in the future. That might be a down payment for a house. It could be paying for an education. It could be all kinds of things that your stocks and other things are not.
Yeah. And something I learned from my own portfolio is this, that markets tend to go in cycles, and sometimes it's 10 years, sometimes it's 14 years, depending on different asset classes. And there have been situations where I've invested really badly, and then when I rebuild, when I climb out of the hill, I accumulate, and then the reward is 10 years later. It's not next week, not next month. So there are ways in which you can correct your portfolio or correct the problems that you have. I wanted to say this about inflation. I think that you've had enough economists on your show, talking about inflation and so on, and a lot of it has to focuses on what the Fed does. But inflation is also driven by the technology companies that have reduced their cost of operation so much that they've been incredibly profitable, that companies like Apple, for example, sits on $2 trillion worth of cash. So they are throwing money into the economy just as bad as and I think that's something that needs to be thrown into the equation, the cash position of large corporates.
What do you mean by that? Yeah.
I mean several things. I mean, companies like Apple sitting on so much cash that their real business is no longer, the products that they manufacture, but the trading that they do in markets. I mean that. But I also mean that technology is turning a lot of data into tradable assets that businesses that can make money from. So, even way back in 2014, Jeff Immelt said about GE that, that GE's most valued assets will not be the manufacturing business, but the data that it generates from all of the activities that it does, manufacturing, trading, and all that. And then it offers the data up to be traded on the market. And so the financial markets are looking for all sorts of data to trade on. Now, not all data are tradable, but the markets will just keep working on it. Like today, the markets are trading climate bonds, for example, and anything that can be financialized are being traded in the hope that, it creates capital for the underlying business, but also it's financial activity for its own sake. Now, the numbers from that get shown up in terms of the contribution of finance to the GDP. Now, in the US, depending on which metrics you use, it's about 7 to 12% of GDP. Now, once it goes up to 20% of GDP, what it says is that you can only be rich if you are in the finance industry. If you're trading, making money as a trader, than any other activity. Manufacturing is about 10% of the GDP right now, or any other activity that comprises services and so on. So,
sure, I was going to ask you about healthcare. I know that's about 20% of the GDP in the United States,
or more.
Yeah, obviously they're doing well, right? How does that impact our economy compared to other economies that don't have healthcare as such a huge part of the GDP?
And let me just interrupt here and say that the U.S. has, I believe, the highest healthcare cost in the Western world. Yeah, in the world.
I mean, you have the best healthcare, but also the most expensive healthcare. So, it's when it comes to leading edge healthcare, everyone goes to Mayo Clinic or one of the Ivy Leagues. But at the same time, everyday healthcare, statins and kidney medicine, you got to go to Canada or to Mexico to buy it, and it's the same manufacturer selling it at a different price, in the US.
Which makes no sense to me. None.
And that's one of the greatest things that I thought we would have learned from COVID and supply chain is to bring pharmaceutical manufacturing back to the States, because then you're running out of reasons to charge more in the States, but that's against the best interest of pharma to do that. So it's all about making money.
I mean, a lot of the generics, many of the generic drugs are manufactured in India, and so the price should be low. I just went. A doctor gave me a prescription for a generic drug. It was for some pain that I had in my back, right? The generic drug on insurance was over $125 a month. And I said, I'll take Advil, and I took a generic Advil.
Thanks, but
and it worked.
So in the US, you're not paying for the manufacturing costs, you're paying for the intellectual property,
right,
and services structure at the back of that. So it's the insurance, propping up the cost so that insurance itself becomes an economy, on its own right. And this try between the insurance companies, the medical profession, and the pharmaceuticals, it's something very difficult to break in the US. And it shows up in the disposable income of an average American relative to anyone else around the world. I come from Singapore, where our per capita GDP now on paper is higher than the US, like $70,000 or $80,000 US a year. Sorry, but and the US is a little lower than that. But our disposable income is much higher because we have a social safety net. Healthcare is subsidized, this, that, and the other. And pharmaceuticals are not as expensive as the US, but not as cheap as India either. That sort of thing. And the average European has an amazing social safety net. They pay incredible taxes, but they get it back in terms of healthcare and so on. So where it shows up is the disposable income of an average American, and things that you need to do, insurance, social security, that you need to ramp that up in order to be able to meet these costs. We just hope that inflation doesn't eat into healthcare as one of the disposable costs that the individual has. It hasn't shown up yet in the US, but if it does, it will have incredible social effects. And you're right, it's almost as if the US didn't learn anything from the COVID pandemic, and that will be sad. But I'm sure that there's already work underway. It's just that the US is looking for a working model that is not called socialism, I guess. So
yes, got to be careful with that.
We really do. Emmanuel, the fact is that the last 5 years, has has been up and down. The debt ceiling, was raised starting 5 years ago or more. What I don't understand is that I think it was 20 years ago, 18 years ago, we had no debt. We got rid of it. And then I go back to the 80s when inflation and interest rates, I mean, my mortgage was 14% at that point. And so looking at 14% versus 5 or 6%, that's pretty good.
Yeah, actually, that phenomenon in 1984, where rates had shot up to 14%, was a direct result of the end of Bretton Woods in 1971. So it took about 10 years for the banking system to figure out how to deal with the mismatch between the assets and the liabilities in the system, the community banks in the US, and many of them went under during that period. So it was a banking system that hadn't recalibrated, once the US dollar was floated freely, as opposed to being pegged to the price of gold. On the one hand, being pegged to the price of gold creates certainty. On the other hand, there was before the end of Bretton Woods, whether you invested in gold or in dollar didn't make a difference because it was pegged. And after that, we all got into a journey where you needed one to arbitrage the other, or you needed one to as a safety, against the other. Now, many countries around the world still hold gold as a form of safety in case the peg to the dollar, is unsustainable. But the U.S. is the one country where the Treasury doesn't hold gold today against the dollar. It's really free floated, and that's a problem because we can't work out what the valuation should be, and that's where the Fed comes in and tries to manage that through liquidity. And
I would love to, if the Feds don't need it, I'll go into Fort Knox and take what I can. We're almost out of time, and I just wanted to ask about the personalization of finance. What do you really mean by that? And that's part of the title of your book, The Great Transition, the personalization of finance, as we wrap up our time together this time, because we're going to ask you to come back.
Well, what I'm saying to people in the banking industry and in the finance industry as a whole, is that because of technology, we are coming to an age where you and I as individuals are increasingly able to manage our own finances, and technology is able to make us able to buy and sell from each other. Even when you buy gold today, you don't have to go to a bank to, lift a ton of gold and say that's mine. You can buy, a spot trading account. You can buy digital gold, all of that, and then you can trade with each other directly. So increasingly, we are moving away from the need for an intermediary. So that's exactly what I'm saying to the industry, and the industry knows that because increasingly, like this year is the year that the Fed is introducing Fed Now, where ordinary people in the US will be able to send money to each other instantly, digitally. So the bank starts to lose the power it had in the payment system, for example. So that power is eroding, and because people gaining a lot of options in terms of how they want to manage their finances, who they want to trade with, the communities that they want to create around themselves, that's changing the face of finance going forward. And that is the subject of another whole conversation.
Well, we will do that. I'd love to have you back again. If you ever get to Southern California or Oklahoma, we'll be able to do this maybe in person. But we really appreciate your expertise and your thoughts. The name of the book, of course, The Great Transition, the Personalization of Finances here by our guest, Emmanuel Daniel, who is a global thought leader on all kinds of money and interest and all that kind of thing. And we really appreciate your spending some time with us. I just have to ask one last question. My time is 10 after 9 a.m. in the morning. What time did we get you up and out of bed or something?
Started at just past midnight, 12:30 in the night. But I'm so global. I just got here in Beijing from New York just a couple of weeks ago, and I'll be back in New York in April. So the time doesn't bother me at all, and it's great talking to you. And Mark, you're out in California, so your time is even more different than Sean. I think Sean, what's your time like?
Yeah, I'm 10 after 11, so I'm Central Time.
Okay.
Yeah, he's 2 hours ahead of me. All right, Emmanuel, thank you very much. We appreciate it. We'll let you get on with either a late supper or going to bed. This is BullionMax, the podcast. I'm Mark Alyn for Sean Reynolds. Have a great day. We'll see you next time. Bye-bye for now.
Don't forget to subscribe. Press the button.